What's up, everyone? I hope you had an amazing weekend. We have a short week this week, but here are the top 5 things that you need to know for trading going into the 4th of July holiday.
So first things first, we have to cover tariffs and trade deal status right now going into the unpause happening on 7-8 and 7-9. We have US and China. Trade truce is in place now with US tariffs on Chinese imports at 30% and China's on US imports at 10% following a deal to suspend those higher tariffs going into the August pause that the US and China agreed upon. Secondly, US Canada. We have Canada, they resigned their digital services tax, resuming trade talks to avoid severe US tariffs post July 9th. Next, we have US and South Korea. The negotiations are continuing with South Korea seeking to extend the 90-day tariff beyond the July 9th deadline. The big talk of the town here is going to be the US and the EU, right? So you have EU leaders are discussing US trade proposals, but talks could fail with tariffs potentially resuming after that July 9th deadline is hit. In general, all across the board, the 90-day tariff pause is set to end on July 9th. That is, of course, that beyond the base of 10%. Trump is currently signaling that there will be no extension, which is leveraging pressure for those better deals. In total, tariffs may resume if talks falter, impacting markets and consumer costs.
Remember, the current buzz on Wall Street is the reason for a 21% sell off in between March and April, on top of firms leveraging into bonds, were tariffs. Okay, now that we have this July 9th, which is a more concrete date, if any extensions were to happen on Trump's end, it would leave a period of uncertainty coming also right during non farm. We're basically on the borderline of the window of weakness going into July OPEC. So could get a little pullback, but more likely than not, the deals that he has on the table are going to stay and there won't be an extension. They want a more risk on environment leading into the end of the summer and the S&P to continuously moving up. So next up, Jerome Powell. He's scheduled to speak on Tuesday at 9:30 a.m. It's the Federal Reserve's Board of International Finance Division. It's the 75th anniversary event. Don't expect anything, adding on top of his recent FOMC meeting to be any different. Every time Powell is on TV, they make sure the market stays green. They make sure he talks about inflation coming down to their 2% target and the labor market remaining strong, which on his accord and whatever he's looking at, it looks to be okay. The Fed is going to stay at that 4.25 to 4.5 target no matter what. There are not going to be any cuts in sight until he sees major cracks or the S&P has a major drawdown. So expect him to stay the course and repeat a lot of the talking data points that he had at our previous FOMC as usual. Okay, so for our next 2 talking points, we're going to talk about Jolts and ADP and then non-farm coming in on Thursday before the weekend heads off. The market is running on a current narrative that both the public and private sector are strong. Now, as we know, the private sector has seen multiple cracks with the longest contracting streak since 2008. It has been contracting for 17 months straight. On top of that, the majority of the jobs that Biden and his administration brought in during his term, 45% were government jobs. And as you guys know, as DOGE has come in and laid off a lot of those people cleaning house, we're not in a period right now where the labor market appears to be strong. More citizens and households than ever are working more than one job at a time. The professional and business services sector has dropped from 6.4% in 2021 to 4.3% in 2024. Construction job openings have declined by over 250,000 in 12 months, and white collar hiring is dropping to 2020 pandemic levels. Out of the last 60 non-farm numbers that have come out, 34 have been revised lower by either 20 or 50%. This as a whole, on top of that 668,000 job decline that was revised early in January this year, does not paint a pretty picture for the labor market. Okay, so let's go over both of these numbers and tell you what we're expecting.
So we have Jolts coming in on Tuesday morning. This is a job openings and labor turnover survey. It's produced by the Bureau of Labor Statistics, and it tracks monthly U.S. job openings, tracks hires, quits, and layoffs, reflecting labor market dynamics. So in April 2025, job openings rose unexpectedly to 7.391 million from March's 7.192 million, though it was below February's 7.568 million. Hiring and quits have remained stable, but recent data suggests a potential decline in hiring momentum. Regarding this report, forecasted to show job openings around 7.45 million, slightly up from April's 7.391 million tag. Analysts highlight focus on hiring trends, with some expecting a drop from already low levels based on claims data. Following up on that, we have ADP coming in on Wednesday. This is the National Employment Report. It tracks monthly changes in U.S. private sector employment based on payroll data. This is that precursor to the NFP, offering a higher frequency view of labor market trends. And given those recent trends, with March at 155,000, April at 62,000, and May at 37,000, analysts are anticipating continued softening in job growth, potentially aligning closer to the consensus for June's NFP at 120K. And then finally, on Thursday, we have non-farm payrolls, NFP. This report measures monthly changes in U.S. private and public sector employment, excluding farm workers, private household employees, and nonprofit organizations. It's a key indicator of economic health, something that Powell and the Fed looks at frequently. NFP is expected to come in with a range of 85 to 190K jobs, with that consensus area sitting right at 120 to 130K. Now, keep in mind a sub 100K figure could signal recession fears, while strong wage growth may influence Fed policy.
Okay, you have all the data points that you need employment-wise for this week. The last thing that we want to talk about is the importance of dealer flow. Every single institution, whether it's a pension fund, asset manager, hedge fund, any institution that has over $1 billion, $20 billion, $100 billion assets under management, okay? These guys are long the market 24/7, 365 across all asset classes. They buy fixed income, commodities, equities, crypto, real estate, etc. They hedge their multi-billion dollar portfolios with derivatives. Okay, this is swaps, forwards, options of various kinds. Okay, when institutions position, they position on OPEX dates and they position on trip witching quarterly OPEX dates. Their hedges come in the form of options as them buying puts. Now, buying puts is negative delta pressure. Okay, when dealers write those puts to the institutions, they're writing to open, they're selling to open. So that is positive delta pressure. Now, dealers do not take sides, okay? They are always delta neutral. So as they are bullish on the writing put side as positive delta pressure, okay, up here, they then have to short the underlying security, which is the S&P down here, to remain delta neutral. As you get closer to that expiration, okay, these trades start to decay. And as these trades start to decay, they become less and less worthy. Just like when you buy an option and theta decay comes in, your option loses its value. So they have to start to buy back their shares to make sure they remain delta neutral. That buying back of shares in huge weight is what pushes the S&P up into OPEX every single month, and it has a stronger effect on the quarterly dates. Now, we just had our June quarterly, and that is completely cleared out. Your next OPEX date is in July. After that, obviously, it's August. This effect of dealer flow and dealers buying back their shorts, pushing the S&P up into OPEX dates, is known as Vanna and Charm decay. Vanna volatility, Charm time, okay? They're hedging these two Greeks to make sure that they stay delta neutral at all times. After non-farm, that comes in this week, you then hit your window of strength leading into July OPEX, where Vanna and Charm decay and dealers buying back their shorts effect is prominent, and continue to move the S&P higher all the way into June OPEX, which is July 18th. Really quick, just hitting the chart so you guys understand. I'm taking the Fibonacci levels just from your mid-range to find your most important micro levels of support. This entire structure used to be selling supply. It is now full-blown buying demand. There is more buying pressure here than selling supply. This entire level of volume is going to act as a support structure for the S&P to continue to churn higher leading into August. Now, can you get small pullbacks on the way? Absolutely, but remember, your extensions on the macro are much, much higher, okay? With these levels in your next pocket looking to be where the S&P makes its next macro stop. So as we go into July 18th, OPEX, just remember, can you make a retracement back to that 608 level and bounce on demand? Sure, but this is going to continue all the way higher, leading all the way into August, no matter what.
In conclusion, albeit this is a short week, we continue to have a strong focus on labor market data, and we await to hear what the trade deals and the tariffs are going to be moving forward after July 9th.
Keep a focus on individual stocks as they're going to be making larger moves than the index as the index continues to churn into the late summer months. And keep your eyes on the options chain with dealer flow coming in hot starting right after non-farm NFP. If you guys found this video to be informative, please hit that subscribe link below. We love you. Have a good trading week. Yo Boss out.